Hi everybody and welcome to this week's video blog. It's Jeff Fitzpatrick and it's US stocks and options. Let's get going. This week I'm looking at what represents a great value stock. Of course, last week it was quality and we want both. So let's get started. First of all, economic official news that's due out this week. And there are only a couple, but they're important. On Monday the 15th, that's today, we've got at 1:30 retail sales, how they're moving month on month, expecting a 0.3% increase. And then nothing really too important until Thursday when we see unemployment claims. That's new claims, and we're expecting something like 211,000 new claims for unemployment benefit in the US. Now, this news, the official news that comes out each week, is really important. So last week we saw a drop in the market, and that was down to news. And we'll come back to this when we look at the indices. But first, some company news. Intel, they're challenging NVIDIA. That's on the AI chip. This was always going to happen. It happened to Tesla when new EV cars came out. So let's see how it moves. NVIDIA is great and it's had a fantastic run and it will continue to do well. It's got first mover advantage, but the competition is coming up. Meanwhile, over at Alibaba, Jack Ma, the founder, he is showing that he's still behind it and that it's moving forward. This stock is probably not well liked by the US government, but it's certainly a good performer. And then we've got Google, and they're coming out also with a new processor and a new chip, Google L. It's new and it's updated and it's got lots of AI capabilities, so it should make a significant difference going forward. And TSM, Taiwan Semiconductor, they are expanding into Arizona. The US government are concerned that too much chip making power is in Taiwan. And as a result, they're putting $6 billion, $6.6 billion into making a new factory by TSM that will be operated by them in Arizona. So TSM, they've got a great boost there. Earnings coming out over the next week or two, and there are quite a lot. There they are. Nothing until tomorrow. We've got the broker, IBKR and Ericsson coming out. Then Wednesday, we've got a whole bunch more coming forward. So we'll be keeping an eye on those day by day to see what goes on. I'm particularly interested in VZ, which is out a week today, as we've got some investment in that. In fact, we have investment in quite a few of these. So let's keep an eye on things. And next, the market indices. Whoa, everything is down this week. The TICN, that is all of the TICN stocks, the stocks that have been a 4x4 and recognized as such by TICN at any time. Even though they're 137% up since the bottom of the market when we were in the lockdown from the pandemic, they fell last week by 8.3% collectively. And that was the biggest fall across these indices. I don't like that. The S&P up 98% since the lockdown, was down 3% last week. The Nasdaq down 1% last week from its 110 base. And the Dow down 4%. So something's going on with the TICN stocks. It may be one or two which are skewing the position. But one thing is also pretty clear. From the history we've seen, we do get a faster recovery on the TICN stocks. So why is this going on? It's down to interest rates. Interest rates are very high at the moment, but the central bank in America have been signaling that rates might start to come down. But with the economy producing really good news last week, lots of growth in it, they're trying to slow things down and therefore are signaling that there might be a delay in cuts to interest rates. And that's what's happening. That's why I think we're seeing the indices come down. But don't forget also, my little note at the bottom there, First of all, TICN is well ahead of the other indices. And secondly, these figures don't include any of the income that we generate through selling of puts and calls, or even interest that we generate by having a lot of cash in our accounts. I think that should add at least 40 points to the index for TICN. Okay, so value stocks. The TICN score for value, you can see it here. It's actually generally called price, but it is about value. It's out of a maximum of 52, just like the quality score. And on the right here, you can see the factors that we put in there. Dividends. It's actually not a question of getting maximum dividends. We don't want to see the company paying too much dividends instead of using the money to reinvest in the company. And it only gets a weighting factor of 1, so it's not a huge factor. The rest are equally weighted. Estimated price appreciation. We want some clever folks at Value Line to be telling us that they expect these prices to rise. We know they are conservative in their estimations, and also that they're independent. But nonetheless, it's important to us. And I'm doing a lot of work at present on looking at how good they are at forecasting. I'm going back a long time. In fact, I'm going back to the pandemic and saying, what were they forecasting 18 months in then and 3 to 5 years then? And how have we actually performed? And what I'm beginning to see, as we get further away from the pandemic, which is now 4 years ago, their estimates are getting better. Who could have actually forecast anyway what was going to happen in the pandemic, or the fact that it would be a pandemic? So as we get to more normal times, and they're not quite normal, they're getting better at it. We also look at the price to earnings ratio. We don't like high price to earnings ratios. A high price to earnings ratio means that things got a long way to fall. And then we also look at the risk to reward ratio, or better put, the reward to risk ratio. They're the factors that we take into account. And now to my increasingly famous filtering of the stocks. I have 222 stocks currently on my watch list, and I need to get that down. And this is how I do it. First of all, I look at the Value Line timeliness scores, and I require a 1, 2, or 3 for timeliness. The score is out of 5, and 1 is the best. Similarly, for safety, on Value Line scores, I want a 1, 2, or 3. A 4 or 5 is no good to me. Then I move to the TICN scores for quality and value. On quality, I want 30 out of 52 as a minimum. On value, I want 40 out of 52 as a minimum. I want the stochastics to be below 20, and preferably to be showing at that V that they're just cutting up above the 20 level. The RSA, I'd like that to be below 30. As far as the risk to reward ratio goes, I'm using the last 52 weeks high price and low price. And I want to see the current price no more than about 35% of the way between the bottom of the 52 to the top of the 52. So I want plenty of headroom based on the last 52 weeks. Then I look at the next earnings announcement due date, and I want that to be more than 2 weeks away. I look at the price, and I'm not really interested in stocks below $5. And at $100, I'm definitely losing interest on the high price stocks. That's purely because of the return on capital employed that we get in trading options at that level. And I've got a new one going in here. I'm also looking at the return on capital employed if we sell puts. So let's see what I've come up with. And here we have them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 or so stocks that this week have passed the tests. They've all got timeliness scores of 1, 2, or 3, safety scores of 1, 2, or 3, quality is above 30, values above 40. I've got a subtotal there. The RSI column, I've simply put as L, M, or H. That's low, middle, or high. We're looking for lows on these really, but it is the least influential of the factors I look at. So I'm not going to exclude something simply because the RSI is a bit high. I then look at the indicators, mainly the stochastics, and I want them to be in an area that I call area 1 or 2 or 3. I'll come back to an explanation of that shortly. There's the headroom. That's telling me the percentage of the distance between the last 52-week low and the 52-week high and where we are now. So on the first one, for example, G, it is just at about 10% of the distance between its 52-week low and 52-week high. I put all of that together, total score, and there we go. Q plus V plus T, quality plus value plus time. And there's the price, there's the earnings date. And at the very end, just sneaking in there, you'll see the annualized return on capital employed. And on G, that is 235%. So what I'm saying there is that if you are to sell a put in G for 3 months out and 2 strike prices up, then you'll have to use some stock buying power. But the return that you'll get on that investment on the stock buying power alone, if the stock isn't put to you, would be 235% per annum. Now, normally I cut this off at 100%, but I've let a few sneak in at the bottom there, 94, 91, and 87%. How very generous of me, don't you think? So a little more explanation on the stochastics and these areas 1, 2, and 3. There they are at the bottom of the page. So in area 1, the stochastics are running below the 20 line. In area 2, the strongest, the stock has just gone from below 20 to above 20. That's the prime spot. That is the sweet spot, if you like. In area 3, the stock's past that, but it's still got a long way to rise. It's going up. Then we get over the 80 line at the top, and the 5 area is running along above 80. If we were selling short, the 6 would be important. It's where the line of the stochastic comes back through that 80 level, the unsweet spot, I suppose. And then the 4, area 4, is in that middle ground where the stochastics are still falling. So that's how I simplify looking at the stochastics. Of course, I also glance at the MACD, and I also keep an eye on the 10-day moving average and the 20-day moving average too. These days, I'm using the safety score to look after the longer term. Now, this is new, guys. So I decided to take the stocks that had come through that filter and have a closer look again to see if there's anything that I found particularly attractive or not so attractive about. And this is what I came up with. So on this chart, I've got the ticker symbol, the current price, that's the closing price from Friday. I've got the price to earnings ratio. I've got the number of shares outstanding, and then BVPS, book value per share. The next is the multiple. So I'll come to that in a moment. We'll go through an example. And then the beta, market change. Let's just go through one to get an example here. So the stock is Genpact. It's been up there for several weeks as a good prospect. Its price is currently $31.21. Its price to earnings ratio is 9.13. Absolutely fine. Perfect as far as I'm concerned. There are 180,300,000 shares outstanding. And the book value of the company divided by that number of shares is $11. So the multiple, if we are going to buy this stock at $31.21, we are paying 2.84 times the book value. That's not actually so bad, but there are better ones. The beta is telling me how quickly this stock moves or how far it moves when the general market moves. And what we're seeing here is at 1.08, if the market generally moves by 1%, then we can see that this stock will move up or down in the same direction by a little bit more. Now, I've also taken a view. I've been looking at this, the S&P 500, and we expect that to go down at the moment. My mate from the goodness knows what century, Fabinici, is saying, look, you're on the third roll, it's coming down. We've seen the turn already. We can see what's happening with the indicators. So I'm looking at the moment at a conservative, probably about 2% fall. It might go by more than that, who knows? So that would say, if the market is falling and that this stock G has got a beta of 1.08, then I would expect it to be falling. And the price it would come down to would be something like $30.54. So if I want to save a bit of money, I don't want to pay $31.21. I'll wait, thank you very much. I then looked at support on the candlestick charts, and there isn't really a level of support below this much. So I put it in at support. So if that stock got to about $30.54, that to me would look like an ideal price. So when I've looked at all of these stocks like that, I found a few good stories and a few horror stories. So OpenTex, OTEX. I don't like the price to earnings ratio. It gets through all of the filters and everything else, but with a 75.79 PE ratio, I'm not keen. It has got a book value multiple of only 2.1. That's good, but I'm not going to forgive it for that price to earnings ratio. TTEC, the same, perhaps a little bit different. It's still high at 46.21, the P to E ratio. However, the multiple is really small. So there's a fair chance that the stock may change. It's only a multiple of half. So basically, this is 56 cents on the dollar. I can buy assets worth $1 for 56 cents. The earnings are going to take they need to improve a bit, but the price should actually rise on the back of the book value alone. Another negative would be on Sealed Air Corporation. Its multiple is very high at 7 times. So perhaps it's not that good anyway. I might let that one drop. But I've got others here. I've got Forward Air Corporation. I've got Pink, and I've got Match, where the multiples are very good. So that's giving me a few more clues on which of these stocks I might care to have on my dance card. Now I'm going to switch and show you a stock that I've been dancing with for quite some time. Okay, so this is the Diamond Investment Club, and the stock that I'm looking at is at the top there, AEIS. And we've had this for quite a long time, I think since 1921, and we paid $100 for it. The current price is $96.52. Bad news, not so good. Thankfully, we've only got 200 shares. However, what I want to show you is this. The exposure on this share is $66.55. We've had $33.45 in income so far. Let's look at the trading account. And here it is, AIS. So we'll scroll down and see we acquired this stock. It was the 18th of May, 2021. Since getting it, we've kept it and we have sold. Let's have a look. Well, first of all, we rolled it forward on a spread. So we didn't get them straight away. We actually took some money for rolling it forward. So yes, we paid $100 for it. Initially, we got $13.30 for promising to buy the stock for $100. Then we managed to sell that promise back to the market for $13.10, and then sold a new one exactly the same for a bit later date, January 22, for $15.90. So we actually then acquired the stock I think it must have been in about January of 2022. Since then, we have been selling calls. Here they all are: 220, 70, 170, 50 cents, 140, 250, 115, 120, 110. And so it went on. We got another one, 310. And more latterly, we had actually promised to sell these shares, don't like doing that, for 105. We bought it back for $9.02 and sold a new one for $10.98. That's to push it back. I didn't actually want to lose these shares. It's become a bit of a pet. And then we've done the same thing again. Said, oh yeah, well, we are prepared to accept $110 for them, but instead of January, let's take it to April and see what happens. And we bought the promise back for $16.57, sold a new one for $18.93. That's how you can own a stock which is at a lower price than you paid for it, but be well in profit. Each week, I'm going to show you one of the positions that we're in one of the clubs and talk you through it. And they won't always be good. This one's a nice one. Some of them are not such good stories. I'll try and mix them in. And that's about it for this week. But next week, I've got something really different and really exciting that I'm going to show you. I've been looking at how Benjamin Graham looked at stocks and did his stock picks. And he was the guy that taught Warren Buffett how to trade. In Warren Buffett's mind, this guy was an absolute superhero, and I agree with him. So I've been looking at what Benjamin Graham did, comparing it to what we do in picking stocks. That's going to be really interesting. So thanks for listening, and I'll see you next week. And by the way, don't forget the live training, 21st, 22nd, and 23rd of June at the Sofitel Terminal 5 Heathrow. You can come for the Friday evening. We'll be doing some live trading. You can come for the Saturday when we're looking at assessing stocks for quality and value, or on the Sunday when we look at puts and options and a lot of the magic, a lot of the research and development that I'm personally involved in. And as finally, if you haven't read it yet, please have a read, listen, or whatever to my book. It has been an Amazon bestseller. It came second in some categories, only to the great Benjamin Graham that I just mentioned. And in other categories, it was a #1 bestseller. Thanks again for listening.